What was the last question? Because the writings got erased. Any idea? Do you remember what was the last question?
I think we finished till um,
88 is done. The reserve ratio.
yeah.
Then 89. Also
89 is also done.
90, I think also.
Yeah. 91 will be money.
Okay. Which of the following is not a reason why a government should have a budget deficit? Political commitments, an aging population, a downturn in the level of economic activity, a fall in unemployment.
Fall in unemployment.
Should not a reason should that they should have a deficit, budget deficit. The deficit is a situation where the incomes are less than the expenditure. So the sources of income for the government is mainly from taxpayers. So the income, if it is less than the expenditure, then there would be a deficit. If the deficit is arising on account of some political commitments or aging population, so if population, if it ages, they come under dependent category. They cannot be productive, so they are not into productive activities. It is for them to retire and take rest. So it is the responsibility of the government to take up the welfare activities for this aging population. So if that is a situation, see, on account of that, see, every economy, every government has to have some measures for the aging population. So on that, if there is a deficit budget, so it is part and parcel of that entire program. A downturn in the level of economic activities go through these stages where they go through, we see inflation. There is an upward rise, it touches the boom, then it falls down, then it goes down into recession, then it recovers. So these are cycles of and it, I mean, that happens because of the economic activity in the economy. Fall in employment is, see, the activity which is taken up is not productive in nature. Production work or employment opportunities are not created by the government. Therefore, there is okay. So there is unemployment in the economy. So that is also a part of it. See here, the unemployment is also falling down. So people are employed, they are productive. Um, Income is generated, yet there is a deficit. That is the situation what we see. See, on account of unemployment, there is deficit is understood. I mean, it can be understood. Unemployment rate is falling, so which means that people have work, they are productive, they are generating revenue. Yet we see that there is a deficit, and that should not be a reason. Okay. See, when people are fully employed, they generate revenues. If they generate revenues, in that case, there should not be a situation where there should be a deficit in the economy. So that on that note, that should not be a reason. 92. Which of the following statements is true? Keynesian economists prefer to use fiscal policy such as changing interest rates to control the economy. Keynesian economists prefer to use monetary policy such as changing interest rates. Keynesian economists prefer to use monetary policy such as changing interest rates to control the economy. We will also once refer back. We'll go back to Keynesian law related to unemployment. We'll touch upon that and then come back and then do. Let me just put you to the. So Key Nation's view about unemployment is due to insufficient demand for labor, due to insufficient demand for the goods and services people produce. What solution did they provided? They provided the solution about solution is to boost aggregate demand, especially by increasing the government expenditure. So government expenditure should increase, activity would increase, more goods and services will be produced. So when the production increases, the demand, aggregate demand also increases. That's the solution which they have provided to deal with the unemployment problem. So now here in this case, the first one talks about fiscal policy change in interest rate. Second one talks about monetary policy change in interest rate. Third one talks about Canadian economists prefer to use fiscal policy such as amending taxes to control the economy. Then Canadian economists prefer to use monetary policy such as amending taxes to control the economy. So is it about interest rate or the main point here we see
Amending taxes.
we
Government
see that
expenditure.
the main issue is about the government expenditure, which has to be increased.
Yeah.
That is the main point, what we see. Now, we've also looked into the fiscal policy and the monetary policy. See, what is a monetary policy? Monetary policy is conducted by the central government to control the monetary policy is designed to alter the level of aggregate monetary demand. So it is to do with the money part of it, monetary demand in the economy. It does so by influencing the and it is inclusive of the interest rate part of it. So by making changes in the interest rate, trying to control the monetary, the flow of money in the economy. So that's the monetary policy. What does the fiscal policy talk about? Fiscal policy is about how the government generates revenue and how it spends the revenue on various activities. That's about fiscal policy. So when we look into the options given, so 4 options, 2 of them talk about fiscal, 2 of them talk about monetary. So first we need to understand, is it about monetary policy or is it about fiscal policy? It is not about monetary policy. See, Canadian's view about solution for this problem is to increase the government expenditure. So it is government expenditure is part of fiscal policy, not monetary policy. So wherever monetary is there, eliminate that. We are left with A and C. So A and C, A talks about making a change in the interest rate. It is not about interest rate. It is only about increasing the government expenditure. So A cannot be the answer. Now, Canadian economists prefer to use fiscal policy. This is the option. And it is about government expenditure. Government expenditure can be spent from the revenue that they generate. And the main source of revenue that they generate is from collecting taxes from the taxpayers. So here C would be the option. 93. Which of the following government policies would not raise the long-term rate of economic growth? Encouraging a higher level of business investment, increasing expenditure on education and training, providing tax relief for companies engaged in research and development, trying to encourage a greater amount of consumers' expenditure.
It's B, ma'am, trying to encourage a greater amount of food.
Which of the following is not the
Not.
not raise the long-term rate of economic growth. So something which is taken up will not be contributing to the economic growth. Okay. What do you think?
It's D, ma'am.
Encouraging a higher level of business investment will increase the activity, more production, aggregate demand increases, and then growth happens. Increasing expenditure on education and training Education and training can be considered as when expenditure is spent on education and training. Those students who are undergoing the training, the learning and training part of it, they don't generate revenue immediately. See, for a student, if, let's say in countries where government provides free education, until the education is done, let's say on an average something around 16 to 20 years of investment has to be made on them. At the end of it, then the revenues can be generated. So they would become beneficial only at the end of that. So then how can we talk about it? See, once the investment is made, so the rate of return or returns from this investment will come at the end of that stipulated period. But then from then onwards, the returns that are earned are very beneficial for the entire economy, because an economy where people are literate, educated with the required skill set, etc., the productivity would be definitely more. So it is considered as a social investment, investing on people, so that these people in turn, when they start um, earning the, or they start being productive, that productiveness benefits the economy at large. Okay. The third one says that providing tax relief for companies engaged in research and development. Research and development is also going to give results. See, out of research and development, how long there would be benefit is not known. Therefore, we call it as discretionary. So, see, out of research and let's say, for example, if you spend an expenditure like rent, how long can you get benefit? 1 month. So if you pay, let's say if you pay rent for 1 month, for 1 month you can utilize that. If you pay, let's say in advance, you pay rent for 6 months, so 6 months you can get the benefit. But see, these are all the cause and effect is very precisely known for certain expenditure. So if you, let's say if you purchase planted machinery, maybe the life of it is 5 years, so you can get benefit out of that for 5 years. Not so with research and development. So when you spend on research and development, the benefit, how long it will last, is most of the time not very sure. So the business tends to get benefited out of this research and development for a very long period of time. So that is the issue with research and development. So right now, the spending on research and development and tax relief provided by the government to such companies looks like an expenditure, but that is contributing to the economic growth. So the benefit lasts for a very long period of time. So they keep getting benefited out of these research and development expenditures. So for a very long period of time, the company gets benefited out of that. Trying to encourage a greater amount of consumers expenditure. The consumers expenditure is in the short run. It is the uh, the demand, trying to encourage them to um, spend more, trying to encourage a greater amount of consumers expenditure. Then what happens if the consumers spend on goods and services? So it is like attracting them or luring them to purchase that. See, the trend should continue in the long run, but that is subject to the availability of income. Then only the overall aggregate demand over a long period of time can be consistently be the same. But other factors are not mentioned, that the productivity would be the same, the production of goods and services in the long run also would be there, and therefore the aggregate demand increases. So such information here we do not see. It is only encouraging them, but how long can they be encouraged and motivated with that? As long as their revenues support them. Okay, therefore this is not for a long period of time, but this can be done only in the short run, short period of time. Okay. 94. When a government wishes to control inflation, it does so for which of the following reasons? Inflation, control inflation. To redistribute wealth from rich to poor people. Inflation damages international competitiveness. Low inflation increases government tax revenues. low inflation reduces unemployment. Inflation is a situation where the prices are rising. We see that there are various views about there are various views about inflation. Demand pull monetarist view talks about excessive growth in the money supply. People have a lot of disposable income with them, so they are willing to purchase any uh, product for any price at any price. So this will cause the prices of the products to rise. So that is what happens, control the growth of the money. So what has to be done, because they have a lot of disposable income with them, that can result in the price rise. So how to control this particular problem? The problem is about excess money supply. So control the growth of the money supply to match the growth of the economy. So this is in turn creating problem in the economy, that because of their willingness to spend higher prices for the products, the suppliers start raising their prices. So it goes to a situation where this disposable income which is available with them is not sufficient enough to purchase the products which are priced by the suppliers. So in that case, that is a situation which we can call it as inflation. So what has to be done? What is the policy which has to be done? The policy is to control the money supply. So once people do not have so much of disposable income with them, they will not be willing to spend at higher prices. So they, if they stop spending higher prices, then automatically things will come under control. So it says cutting government expenditure to avoid having to print money, borrow money or borrow, increase interest rates. So when interest rates are increased, automatically the productive activity um, slows down, because at high interest rate, producers may not be willing to borrow the money, invest it into productive activity and carry forward with that. So it slows down the productive activity. Okay, then not so much of revenue is generated, then disposable income is not available in the hands of people. So that's how then open market operations, wherever government has to um, sell the securities, it sells the securities so that people buy. When people are buying, the cash flows are moving into the hands of the government. So in that case, the supply of money in the economy uh, comes down. So the availability of money in the economy comes down. So that is about the inflation. Okay, but how to measure the money supply is a problem. Coping with the adverse consequences. Once the consequences of high interest rates, so automatically when interest rates become high, productive activity slows down. Productive activity slows down. Then the adverse effect of that is people don't have employment. Okay, so those are the issues. So then we also see that Keynesian has given a view. It is because of excessive aggregate demand. So people have uh, are willing to spend uh, lot of money for the product. So demand increases. So the aggregate demand increasing is the cause of it. What's the solution for that? What's the policy? Reduce the aggregate demand by cutting down the government expenditure or increasing taxes. The cutting down on the expenditure slows down the productivity. Increasing taxes, people will not have lot of disposable income with them. There is another method, cost to push view of it. It says that cost factors such as high union power, oil prices, imported raw materials, all these things will rise the prices of the products. So anything to do with the price and income policy can be adopted. So that is about inflation. We've done the other day. So something related to how can the government control the inflation? It does so for which of the following reasons. So for which of the following reasons? We've read through four of the options. Which one looks more appropriate? Why would the government want to control inflation?
Inflation damages international competitiveness.
Because it is not about equal distribution of income It is about having a control over the prices. That's the main point. So everything connected with the price, that's the aggregate demand, the productivity, interest rates, etc. All of them that are connected with that will be part of the steps taken by the government. It is not include. It is not focusing on social justice. That is equal distribution of income is not the criteria here. Then low inflation increases government tax revenue, or low inflation reduces unemployment. See, how does it want to control the inflation, or why does it want to control inflation? If inflation is controlled because their presence is in the global market, high prices in this economy can have an impact on the international demand. People, when they demand their products and services, but their products and services, if they are at high prices, that will have an impact on the international demand. So that is not advisable. So therefore, inflation to control the damage caused to international competitiveness, government wishes to control inflation. The government's tax revenue increases by increasing the main sources. Main source of revenue is from taxes. So low inflation increases government tax revenue. They are not so directly connected here. So that cannot be the answer. Low inflation reduces unemployment. See, actually, in the process of cutting down on the inflation, one consequence or side effect is the unemployment increases. Okay, so it is not for that reason. It is for the reason that they have to be placed well in the international market. So the international customers should not look at their products as something which is charged very high in price. 95. If governments were seeking to reduce unemployment, they should perform which of the following actions? If they are looking at reducing the unemployment, how can unemployment be reduced? When the productive activity increases. When the productive activity increases, more goods and services are produced, more employment opportunities are available. So now in that situation, what do we look at? See, when how to increase the productive activity, producers should be willing to take up more productive activities. So the funds which they borrow, these funds should have higher interest rate or lower interest rate. Definitely not higher interest rate. It is about lower interest rates. So between A and B, lower interest rates will motivate them to borrow more funds and invest in productive activities, invest more. When investment is more into productive activities, more production happens, more jobs are created, unemployment problem is solved. Then, but this is there for two bits. So is it raise taxes? If taxes are raised, less amount of disposable and income in the hands of the consumer. So lower taxes. So it is not only about interest rates, it's also about lower taxes. Which of the following is not an argument in favor of a minimum wage? Not. It seeks to eliminate the poverty trap. It seeks to prevent voluntary unemployment. It prevents people from working below the minimum wage. It seeks a more favorable distribution of income and wealth.
See, ma'am, it prevents people from working below the minimum wage.
Not an argument.
Yeah, since others have helpful for minimum wage calculation. The other three options.
See, one of the reason is to eliminate the poverty gap. Minimum
Yeah.
wage they can earn. Okay. Prevent voluntary unemployment. Okay. So if there is generally it is said that whatever are the rewards that are given to employees, they should be attractive, they should be motivating. Otherwise, if the reward itself is uh, um, unattractive, in that case then we see that they don't like to see, unless it is attractive, they do not work. They feel that what is the point of working hard when this is what they have to get. So that kind of creates some kind of demotivation among them. So if the minimum, if they feel that by working hard they can meet their basic needs, then they feel motivated in spite of working very hard. Also, if the condition is the same, then they feel that as well they do not work. Okay. So to seek to prevent voluntary unemployment, to it prevents people from working below the minimum wage. Yes, it D says it seeks a more favorable distribution. A and D kind of are on par, so we go with C. Which of the below is an example of fiscal policy? Fiscal policy is about the government uh, revenue, how the revenue is generated by the government and how it spends this revenue on various welfare activities. It is all part of that. So we have four options. Central bank imposing controls on commercial banks. If it imposes controls on commercial banks, it talks about the cash reserve ratio. How much should they maintain the reserve and to what extent they can extend. So it is basically about controlling the money flow. So it becomes monetary. The removal of regulations which restrict Sunday trading. See, that is part of um, the regulatory body taking a decision about the activities in the stock market. Removal of regulations which restrict Sunday trading. It is not to about how the government takes decisions about revenues and expenditure. So B is also not the option. The removal of foreign exchange controls which restrict the transfer of currencies between countries, that is completely to deal with the import export, the balance of payment, those aspects of it. D says the creation of tax exempt individual savings account. So here it is related to what amount of tax would be collected from individuals. So basically the tax uh, amounts are the main source for the government. Then how they would spend on that. So an example of fiscal policy will be associated with something to do with tax part of it. So D will become the option. Okay, so now in terms of MCQs, we are on par. Let's quickly go back to the PPT. From today, your classes have increased. Otherwise, it was there were only two classes, no, every day.
Law was going on, but 2 3 days sir didn't take law classes. So yeah, but from today it will be continuous, 2:30 to 5 also.
Three classes are there from today.
Yeah.
This is just now I saw a message in that group. It's 2:30 onwards. You have another class.
We did have 3 classes at the start also, ma'am. But last 2 3 days sir didn't take classes for law.
We didn't discuss anything about interest rate management. Let's start discussing about this one, interest rate management. Interest rate management. What is the impact of increasing interest rates on the economy? If the interest rates increase, for some of the questions we've discussed, but formally, let's have also a discussion about impact of increasing interest rates on the economy. Internal factors are consumer spending falls. Why? If interest rate increases, productive activity is curved down or cut down, the aggregate demand falls, income levels fall, people also spend less. Investments fall because producers are not willing to borrow at such high rates of interest, so investment falls, asset values fall, savings may rise because people are not spending on all types of products because the scenario is that the prices are very high, so they may not be willing to spend at that point of time, but wait until a later period of time where the prices fall. So savings may rise, then aggregate demand falls. That is the ultimate consequence. The aggregate demand falls because borrowing and productive activity do not happen at the regular rate of activity. So when productivity reduces, aggregate demand also falls. What happens to the external factors? Foreign funds are attracted, exchange rate rises in the short run. So maybe the foreign funds are much cheaper because interest rates here in the economy are high. Borrowing from other sources may be economical. Net effect is inflationary pressure reduces, so that flow of money into the economy is cut down, so that pattern of people spending high on goods and services, that comes down, so the inflationary pressure reduces. So impact of increasing interest rates on business, the cost would rise because interest rates are high. Productivity, if it is not at high rate, then when the production reduces, the aggregate cost also increases. So cost may rise, investments fall, they are not willing to borrow, so investments fall. Not much of productivity, not much of goods and services are produced and sold, so therefore sales revenue also may fall. How to manage this interest rate risk? See, when there is a fluctuation in the interest rate, see, people sometimes may get benefited or they may get adversely affected. How that is a risk. Risk is any variation in what is expected is called as risk. See, if they have expected that interest rate would be at a particular rate and then they take up plans regarding the future courses of action, but the result is that if the interest rates fall, in that case, things may not go according to how they have planned. There would be variation in the plan. That can be referred to as risk. Okay, this risk exclusively arising because of fluctuations in the interest rates. See, interest rate is rising, interest rate is increased by the government or the central bank and all, is part of some other course of activity. So they, in terms of bringing down the inflationary pressure, they may increase that. But for the individuals, for the businesses, that will cause some amount of risk to them because what they have anticipated, what they have planned would not be accordingly because of the rise in the interest rates. Okay. Financial managers face risk arising from changes in interest rates. What is planned and what actually happened, when there is a difference, when there is a variation, that can be referred to as risk. And this risk is caused especially on account of interest rates. Managers are normally risk averse, so that they will look for techniques to manage and reduce this risk. I don't know whether you are aware of derivatives, forwards and futures and options. I'm not sure. Are you aware of derivatives?
As in finance terms, ma'am,
I didn't understand, sorry.
I asked derivatives as in finance terms, like
No, I don't want an answer, but have you ever learned about what is the derivative?
No, ma'am, we didn't have
So
it.
right now also we will not get into those details, but simple explanation I will give you about. See, when they enter in, when they sign up the derivative, it means to say that they are entering into an agreement. When two people or two entities enter into an agreement to take up an activity on a future date, not today. So today they may enter into an agreement either to buy or sell something, some commodity, some product or some services, some commitment they will fulfill. This would be on a future date. How do they decide on that is, see, whatever is the activity which they are thinking about, that activity will be fulfilled on a future date. Okay. See, when there is an agreement legally abiding, then they are also legally bound by the consequences. If they do not fulfill that, they have to also face the consequences of that. So, in simple terms, just remember, derivative is a agreement between, or it's a contract between two entities. Those could be individuals or organizations, but it is between two entities. So they enter into an agreement and do what? They would be fulfilling the terms and conditions as on a future date. See, on that future date, that is to maybe buy a product. One entity will be buying the product, the other one has to sell. See, that is with specific to so many transactions. It could be about the agricultural product. See, the agricultural product which would be produced and sold, maybe the product is still not available, but as on a future date to ensure that the market rate of that would be at a particular value. It would not go down for the producer, then he would be adversely affected. For him to be assured of the income he can generate from this agricultural produce, he decides a price. The buyer also agrees to buy the product at that price. This would be irrespective of what is the rate that is prevailing for these products in the market as on that date. It could be higher, it could be lower, whatever it is. Because they have already entered into a contract, an agreement is agreed upon by two entities. They are legally bound by that, and then they have to fulfill that. In situations where one party is unable to fulfill that, they will have to pay some premium amount to the other entity. Of course, there are many intricacies for that. As simple as possible, I have explained it what is a derivative. Under derivative, there are four different types of derivatives. One is forward, future, option, and swap. There are four types of derivatives. So here, the fluctuation in the interest rate. See, the interest rate may fall or interest rate may rise. But no matter whatever is the interest rate, if they enter into an agreement to fulfill it at a future date, okay. Now, in that situation, um, they they agree upon to fulfill the agreement or to complete the contract at whatever is a fixed interest rate. The market may have any kind of interest rate, but their agreement will be at a specific interest rate. That is, when they enter into the, as I mentioned that there are four types of derivatives. One is a forward, then we see there is a future. Third one is interest rate. There is no mention about swaps here. Fourth one is so this is an option. Fourth one is a swap. We are not given anything about that. See, forwards and futures are, both of them are alike, except that futures are more secure because they are traded in the market. Forwards are over the counter. Anybody can enter into the agreement. So the chances of not fulfilling, there is the breach of the agreement is high in case of forward rate agreement. But futures, they are more secure because these futures or these agreements are traded in the markets. Therefore, there is a regulatory entity which will regulatory body which will look into the details. If somebody is not adhering to the terms and conditions, if there is a breach of the agreement, then they are legally bound for any kind of an action taken against them. So forward rate agreement locks the company into a target interest rate. So they decide on what would be the interest rate. They fix on that. They lock on that. The market also on that date, the future date, the interest rate could be anything, but they will fulfill their agreement at the rate at which they have locked the interest rate. Okay. After that, hedges both adverse and favorable interest rate movement. So it could be, it's not always that only one party will get benefited. It would be both ways. It could be adversely affecting or unfavorable or favorable. Both kind of fluctuations are uh, freezed, or they are taken into consideration. They are locked. The company enters into a normal loan, but independently arranges an FRA with the bank. So after borrowing, also the forward rate agreement also can be taken up. They can sign that. Futures. So they can also sign agreements with futures. So futures locks the company into an effective interest rate, hedges both adverse and favorable interest rate movement. So both of them are on par. The only thing is this is over the counter. Anybody can agree to fulfill an obligation on a future date. So this is all over the counter. So in that case, default also would be high over the counters because there's no third party to intrude in case of a default happening is not present in case of forwards. But futures there is, because these are all traded on the market. Therefore, see that security is high in case of futures. Okay. Third one, it is an option. Option is whether, see, the writer of the option will have, he will have the option whether he wants to exercise the option on the future date or not. See, if he does not exercise it, he will have to pay a minimum amount of premium to the other party. But it is his that option, that facility is given to the writer of this derivative to fulfill it on a future date. If it is beneficial for him, he will fulfill and be benefited. If it doesn't seem to be beneficial, he has an option not to fulfill that. Therefore, by not fulfilling it, the other entities would be at a loss if he does not fulfill. Therefore, there is some amount of option premium which has to be paid and things can be settled so that the other person is not at a loss. See, an option on forward rate agreement allows the company a period of time during which it has the option to buy an FRA at a set price. Like all options, there are these topics are very big, many characteristics, attributes, etc. You will be learning that because there are many financial related papers. So F1 is one finance related paper, F2, F3, all of them are related to financial. So financial derivatives, all instruments, all types of financial instruments, you will study in detail because for now it is only we are touching upon that and moving ahead. We cannot spend a lot of time on the explanation of derivatives. So here the interest rate fluctuations, it is, since we have touched upon how the aggregate demand, how the unemployment problem, etc., those things have to be solved. So one solution which is provided is to raise the interest rate. If the interest rate increases, if the interest rate fluctuates, then that will have an adverse impact. That is what we have discussed. So in that case, so if there is an adverse impact because of fluctuations in interest rates, that loss or that risk, whatever arises, can be minimized with the help of these derivatives. So these financial instruments, whatever are available, with that thing. So basic knowledge, if you can have, so we cannot always say that interest rates are rising. It can have very adverse consequences. See, those consequences, even if they're there also, those things also can be managed, is the topic what we're discussing. Okay. Like all options, interest rate guarantees protect the company from adverse movements and allow it to take advantage of favorable movements. So that is about managing interest rate risk in detail with the numerical questions. You will be learning in the coming papers. There are many papers which you will be looking into, especially related to managing financial risk, etc. So risk management, financial aspects, um, you will learn that in detail. So right now, let's not deviate. It is only just touching upon that. Do you want to have a break for 5 minutes? Are you there, Kavya? I asked you, do you want to have a break for 5 minutes?
Yeah, ma'am. That is what I don't think so. Ma'am, can continue for like
Okay, okay, okay.
yeah. I just spoke without unmuting. That is why it is wrong.
No problem, no problem. Okay. The previous chapter was about the domestic economy. So when we have discussed about the macroeconomic aspect of it, what is that in the domestic economy? That is what we have in detail discussed. Now, what about the macroeconomics and institutional context in the international economy? So, the topics what we will be looking into. So, we will be looking into what is international trade, protectionism, balance of payment, fiscal analysis, and globalization. What is international trade? Trade between economies, trade between countries. So, international trade. So, first we should understand what benefits are associated with international trade. See, one major reason why people enter into international market is maybe because of growth aspect, because the domestic market is completely explored. They might have touched upon every part of the domestic market, the consumers, so they might have reached that saturation point. So they have reached that peak point. So if they want to further grow, then in that case, the next market is the international market. So they would enter into a global market. Okay. Um, Global market will talk about more profitability. So whenever they want to maximize on that profitability, one option which can be considered is to enter into the international market. See, then they start producing at higher scale of production. Higher scale of production will minimize on their cost. Economies of scale can be realized. Okay, more efficiency because they have to cater to the international customers. Lot of customization can be taken up. More features would be added. Increased competition or competitiveness, and then quality measures can be adhered to because they have to face the players in the international market. So, what are the benefits of international trade? It says that in addition to the benefits derived from the specialization through the principles of comparative advantage, international trade also. Because now they would be standing on par with the foreign players. So, whatever the foreign players are providing, they would also be catering to those standards. So, if that is the situation, then we see the quality standards would automatically increase. Then we see reduces cost through economies of scale in the export industry. More production will definitely result in economies of scale. They start producing at a higher scale of production, higher scale of production. More is the output produced, less would be the cost, economies of scale. Provide access to products which might otherwise be unavailable. So that customization would be taken up to, because they have to satisfy the consumers in the international market. So provide access to products which might otherwise be unavailable, increases competition in domestic markets, thus giving consumers more choice and encouraging domestic producers to become more efficient. That is a reduction in inefficiency. Okay. Institutions encouraging free trade. What are the institutions? So one is World Trade Organization, European Union, Group of Seven, G7, what we call. These institutions encourage trade happening on international front. They encourage economies to participate in the international trade. So for that reason, here we see that there is regional integration. Countries may integrate to form trade blocs, free trade area where internal barriers to trade in goods and services are removed. See, sometimes the governments also have a policy with especially attracting the foreign investors to come forward, invest or do business in their economy. They may ease the process. We see even the Indian government, also certain state governments are also very particular that they want foreign players to come forward and then invest in their economy. They want the foreign players to start companies and do business, um, or invest into the local businesses which are here. So attracting foreign investments, encouraging them to come forward and then start businesses. So that even in India also we see that. So they ease the process of registration, licensing, etc. Those things. So free trade area, internal barriers to trade in goods and services are removed. So they ease that entire process. Custom union, free trade area, plus the establishment of a common external tariff. So certain kind of um, measures that are taken. Single markets, free trade areas, plus the free movement of labor and capital within the market. It may also be a customs union, but doesn't have to be. Economic unions, we see single markets with a common currency. So how they would be trading when they have to trade with foreign players, and then foreign currencies are involved, then um, any fluctuations in the foreign currencies also will have an impact on them. Therefore, economic unions, so single markets with a common currency. What is the common currency which is there in the European market? Euros. The European Union is an example of an economic union. The North American Free Trade Area, NAFTA, is an example of free trade area. If time permits, we will spend more time on this, but let's proceed further with the other topics. Once we finish the content, maybe we can spend a lot of some more time on the other topics. protectionism. What are the methods? Countries might try to limit imports by import taxes, customs duties, quotas, non-tariff barriers such as safety regulations, subsidies to domestic producers. One second. Sorry. We have started with international trade. So encouraging one main reason what I have mentioned about why they would venture into international market or take up or be involved in international trade. The main reason is to ensure that more profitability and growth happens. So economies of scale are possible. Will be able to cater to a larger market. Maybe they want to get into diversification. So these are the reasons why people or organizations enter into international market globalization. Okay. See, there are certain measures where the free trade area internal barriers to trade in goods and services are removed. If that is what happens, so the domestic organizations get affected because foreign players enter into the market. See, their market share gets affected. Their customers are they get attracted to the foreign players. So the businesses have to suffer. Okay. If that is the case, we see protectionism. So the countries might try to limit imports by. So if they are depending too much on the imports, encouraging international trade to happen, see, of course, international trade has its own set of benefits, but that is basically affecting their um, um, local people. So the local suppliers, the local businessmen, they get affected when foreign players enter into the market. Of course, from the point of view of customers, customers are provided with better products and services and then better benefits, etc. That is on anyway there, more quality, more features. What they earlier thought was not unavailable now is available. See, from customer's point of view, that is really very attractive. That's fine. But then what about the producer? What about the supplier in the domestic market? So though they encourage, though they open trade with the foreign players also, there is some amount of limit also which is set up. Okay, otherwise sometimes foreign players are so powerful that they can just erase all the local businesses from the market. So such a thing not to happen, they can have a limit on the imports. The countries might try to limit imports by first one. They can increase the customs duty. So whenever they import the material from foreign countries, so on that, if customs duty has to be paid. So only those businesses which can afford to meet such high cost on this material um, will stay in the market. Others may not afford to spend so much, so they may exit from that international market. The next one says non-tariff barriers such as safety regulations. So certain other regulations can be imposed. So that's another thing. Um, then subsidies are given to domestic producers. So they, I mean, so that they can still survive in the market, even in when they have to face competition from the foreign players also, they still will be able to survive in the market. So subsidies are provided to domestic producers. Governments attempt to justify this trade protection as so that part of it is these measures when they are taken up that will protect the domestic players. That's protectionism. Okay. Governments attempt to justify this trade protection as protecting employment in contracting industries. Okay. See, if these measures are taken up and the domestic producers and suppliers are protected, people who are working in those organizations, they are also protected. So, protecting employment in contracting industries, then in protecting infant industries, which are newly established. Okay, so that is another reason. Preventing any kind of unfair competition because foreign player may be very powerful. They the player may rule out the domestic players completely. So that should not happen. See this is for encouraging more activity to happen, more possibilities, more choices available to the consumers, better trade activities happen, foreign reserves improvise, etc. See, the relationship with the foreign economies improve. There may multiple things, but that should not result in the foreign players ruling out all the domestic players and their presence only is seen in the market. Such a thing should not happen. Once the such thing happens, the foreign player can become a monopoly. Only he is there. Then some certain kind of unfair trade practices also may be followed. For that reason, preventing unfair competition. Then we see protecting the balance of payments. So there should be balance between what is imported and what is exported. So um, that is protecting the balance of payments. Now, if protectionism is considered, what are the problems which can arise? Problems using protectionism to limit imports may have disadvantages. So what are the disadvantages? Inefficiency is encouraged because competition is limited. The government is supporting those industries that are in sunset, those industries that are sunrise, that is at the verge of closing down. So some of them may have reached their peak and then they would be thinking about closing down. Abruptly, they also close down any workers which are in the in contracts, they would get affected. So to protect them, sunset industries are protected, sunrise industries are protected, ensuring that the local players still exist. Okay, if that is there, they may not be as efficient as the foreign player. still they can survive because government is providing all kinds of support and encouragement to these players. And in that case, if even if they are inefficient also, government still encourages them. So that will become a major problem. Inefficiency is encouraged because competition is limited. Prices are raised, though in reducing living standard. Prices are raised, thus reducing living standards. Retaliation on the country's exports may occur. If they have restrictions on imports, so also the foreign governments also will have a restriction on what they are exporting, because their products, if, when they want to export, if there are restrictions on the imports, the one way is to have some restrictions on imports, so increasing the taxes, etc. So if that is what is going to happen, same kind of a response or retaliation also can come from the foreign countries. So retaliation on countries' exports may occur. The resources are misallocated. Industries which do not have a comparative advantage expand, and those which do contract. Retaliation on the country's exports may occur. Resources are misallocated. Industries which do not have a comparative advantage expand, and those which do contract. Income distribution is altered, with income being shifted from consumers to producers. So it is the protection of the producers. That is what is looking at. The protectionism is looking at protecting the producers. They are encouraged to stand in the market, face the competition with the foreign players. So if that is not there, consumers will be provided with the best of quality products from the foreign players. So quality standards will be adhered to, better quality, better pricing, all those features will be available to the customers. But by protecting the producers, the focus is shifted from the consumers to the producers. Next, we see balance of payments. The structure of the balance of payments. The balance of payments has two main elements. First one, the current account, all trade in goods, services, and payments for factor services. The capital and financial accounts, all transactions in external assets and liabilities such as capital inflows and outflows. First one is the current account. See, when the let's see the definition first. The balance of payment definition. The balance of payment accounts are a statement of all transactions between a country's residents and the rest of the world. Accounts, these are balance of payments accounts are a statement. So how they import and then export, and what is the result of these transactions? How do the cash flows flow into and outside out of the economy? So the first element is the current account. All trade in goods, services, and payments for factor services. We see these things in the current account. The second one is the capital and the financial account. The capital and the financial account, all transactions in external assets and liabilities such as capital inflows and outflows are accounted here in the capital and financial account. See, the balance of payments always balances. There may be a surplus or deficit on the combined current and capital account. This is financed by a deficit or surplus on the financial account. So, if at all, if there is more receipts than the payments, that surplus can be invested in some opportunity. But if there is a deficit, so additional funds can be raised so that this deficit can be met. Shall we look at few questions and then come back to do globalization? Um, Today we'll
Yes,
finish
ma'am.
this particular topic, globalization, fiscal analysis. Only two are there. Let's finish and then go to the questions. What does it
Yes.
mean by globalization? So the links between economies in a globalized world. The main links between economies are international trade in goods and services. The ratio of trade to national income has risen in virtually all economies. See, they enter into the global market and trade in the global market. So their presence can be seen in the global market. So international trade in goods and services. So the ratio of trade to national income has risen in virtually all economies. The main reason why they enter into global market is to increase their profitability or increase their income level. So the economies also gets affected because of trade with the trade in the global markets with the foreign countries, foreign players. So here we see that the ratio of trade to national income has risen in virtually all economies. Fine, ratio of trade in goods and services, the ratio of trade to national income. International trade has increased, so the income also has increased. International movement of capital and labor has increased. The development of international markets for resources, including capital and for foreign exchange. The growth of multinational companies, okay, where their presence is seen in multiple countries. Impacts are industrial relocation. Industries are relocated. Emergence of growth markets, access to markets, and enhanced competition. So that is all the benefits that are provided to the customer or the consumer. So consumer is provided with better options, better quality, better features, better facilities. The, earlier, what was not considered, what was thought of not possible, not available, or also possible here because of globalization. Cross-national business alliances and mergers happen. They join they join business with foreign players, cross-national business alliances, and mergers of businesses across different countries also. That is possible to happen, widening economic divisions between countries. So these are the results of impacts or consequences of when globalization happens. So allowing global players or foreign players also to enter into the market, they themselves enter into the foreign market. So there is an increase in the activity, increase in the trade between different countries. Okay, so it is impacting the economy in more favorable ways. Of course, there are adverse consequences also, like the producers get drastically affected. Okay, sometimes they may also even have to quit the market. So that is one major issue. Then slowly the domestic market will be ruled by the foreign markets, the foreign players. So such kind of disadvantages are also there, but as long as the government is there to intervene and then protect the producers, then it will not have such an adverse effect. But otherwise, we can see that there's so much of benefit which is caused to the economy. Then, see, there is one type of analysis called as pest analysis or pestal analysis. See, whether it is in a condensed form only pest or elaborated format pestal analysis. uh, this talks about basically a type of an analysis taken up by the businesses before they start planning on the business activities. Pestle analysis talks about each of the letter in this particular word, pestle, represents a particular factor. P stands for political, E stands for economic, S stands for social, T for technological. The second is stands for environmental or ecological. L L stands for legal. See, these all of these factors affect the business. The wherever the business is located or whatever is that. See, these factors, because no business can exist in isolation. They are part of a particular economy, the way the activities are carried on. So definitely every business will be um, affected because of these factors. P talks about political. So what's the political stability, instability in the in the economy? See, if economies with greater political stability, they can attract more investors, more players can enter into that market, and then globalization happens. Trade is at its, I mean, there is an increase in the level of activity with the foreign players, etc. increases. But let's say economies where political instability is there, do you think the foreign players would want to enter into the market? No. Okay, that is, see, in terms of international business. Even in case of domestic business, also political stability and instability will have an impact on the organization. Okay, legislation, government policy, import duties, etc. All these things are the decisions of the political parties. So that whatever decision they take, that will have an impact on the business. Okay, anything. See, L given below, which is the last one. See, L talks about the changes in the laws and regulations. So L is legal. All legal aspects are covered that. See, if the analysis is mentioned as pest, still it will be covering that. See, pest or pestle, all of them, I mean, whether it is only four variables PEST or six variables PEST-EL. See, if it is only pest, L will be usually clubbed with the P, and together they are considered as one factor. L talks about the legal aspects, the regulations, whatever are the rules and regulations which are laid down for the businesses in the economy. Changes in law and regulation affecting, example, patents, competition, sales or goods, pollution, working regulations, etc. So multiple things, multiple rules and regulations which are levied for the or laid down for the organization. We can see them as a factor of legal. Then we see the second one, E, economic pest is, the first E is economic. The second variable in pestle. Economic talks about what is the international situation, domestic development, population growth, etc. So what is the scenario in the economy all about? See, what is this economy? See, the scenario in the economy about what's the GDP, what's the growth rate, what is the development in that economy. Okay. Um, see, likewise, see, anything which is part of the economy which can affect the business is an economic factor. Those factors also have to looked into, taken into consideration. What are the trade cycles in the economy? See, during a recession, the foreign players also do get affected because of recession. So during boom period, they get benefited. So as part of the economic, what is the situation in the economy has an impact on the businesses, economic factors. S is social. Social is basically about the people in the economy. What are the social, cultural, demographic attitudes, beliefs, education, lifestyle, etc. So multiple things are there affecting the people. So the ratio of male, female, see the cultural differences, the habits of the people, their lifestyle, their attitude, their belief, the education, all of them related to people. See, that can have an impact on the way the trade is carried on in the economy. Then technological part of it talks about the technology, how much they have adopted and what advancements are there in the technology. Did they update themselves with the technological changes? So that talks about T, technological changes in material supplies, processing methods, new product development, etc. So multiple areas wherever innovation is introduced, wherever innovation is looked at. See, it is about the technology related. It is also about the innovation into accounting methods and procedures, etc. Environmental is if the organization, because of its activities, has an impact on the environment. So there are certain rules and regulations to uh, uh, govern or restrict the amount of pollution they generate, and that which can have an impact on the environment. So organizations are also expected or supposed to comply with the rules and regulations laid down because of the negative impact they can have on the environment. So environmental factors. The last part of it is L is legal, that is laws and regulations and rules. Okay. That now is about pestle analysis. So we have briefly discussed about this particular chapter, the international economy. Okay, let's discuss the questions related to these topics. Not very difficult, general ones only. So if we discuss that, so today, if we discuss that, that would be sufficient. And then next class, we can take up the next chapter. Macroeconomic and institutional context to the international economy. Then we see which one of the following is not an economic advantage of international trade. See, which is not a advantage or benefit. That is the point here. A says it encourages international specialization. Consumer choice is widened. I hope you're able to see the screen. It says it encourages international specialization. Consumer choice is widened. Enables industries to secure economies of large scale production. Trade surpluses can be used to finance budget deficits. Is not an economic advantage.
It will be
See, one is an advantage, international specialization. What earlier was not available, they can have an access to that. Okay. Then we see the next one, consumer choice is widened. Consumer is provided with better products and services. C says it enables industries to secure economies of large scale production. So when the production increases, economies of scale is obvious reason. Okay. Then trade surpluses can be used to finance the budget deficit. So that is not the reason why international trade. International trade is to maximize profitability and the level of activity. 99. Which of the following is not an example of protectionism? Export subsidy, fixed exchange rate, import quota, import tariff.
Fixed exchange rate.
It's not about the exchange rate.
No.
We didn't discuss this quotas. That's what it was. Import tax, custom duties can be increased or define or decide on how much how much can be imported, how much can be exported. There is a set limit which is there. If they decide on the quotas, that is how much can be imported, how much can be exported. So in that case, the local suppliers, the local producers can be protected. So for that reason, um, quotas are used. So if there are import quotas or import tariffs and etc., so that is part of protectionism. The exchange rate, keeping it fixed, so that is not an option. B. Why do countries impose tariffs on foreign goods? Tariffs, rates. Why do they impose tariffs on foreign goods? To prevent unemployment overseas, to prevent unemployment at home, to encourage free trade, to help lesser developed economies. See, as part of protectionism, they're now part of protectionism. There are certain measures that are taken. Import taxes or custom duties are increased. Quotas are set. Okay, quotas are set. Non-tariff barriers such as safety regulations, certain things are mentioned, subsidies to domestic producers, etc. So these are all taken up. The question here says, why do they impose tariffs on foreign goods? So it's all part of protectionism. So to prevent unemployment overseas, it is not about protecting those that are in the foreign countries, providing employment. It is about uh, ensuring that the domestic entities get advantage or benefited out of protectionism. See, one of the reasons is to protect the workers in the sunset industries, sunrising industries. So protecting employment in contracting sunset industries, protecting infant or sunrise industry. So employees are protected in the domestic economy, not in the international economy. Okay, so prevent unemployment at home so that they do not lose their jobs. That is the primary objective here. So to prevent unemployment at home, not about encouraging free trade or help lesser developed countries. Which of the following best describes a customs union? An area of the world where you pay no tax, An area with the same unit of currency. A free trade which requires for fixed exchange rate between member countries. A free trade area within a certain group of countries who have a common tariff with the rest of the world. So actually, the we will also look at the PPT ones. Regional integration. Custom union is free trade area plus the establishment of common external tariff. The question here is also addressing about custom union. So, which of the following best describes the custom union is the question what we have read through. So, free trade area is where internal barriers to trade in goods and services are removed. Custom union is, see, apart from the free trade area where the barriers are removed, plus the establishment of a common external tariff. There is a common external tariff. So free trade area is there. Okay, so between C and D, free trade area is there. With a common tariff. With a common tariff is with D. A free trade area within a certain group of countries who have a common tariff with the rest of the world. 102 says that if the elasticity of demand for British exports is -2, then the devaluation of sterling should lead to dash. A fall in the value of exports, an increase in the value of imports, an increase in the total foreign currency expenditure on British goods becoming more expensive, overseas. Elasticity of demand for British exports. So, how do we define? So, the demand, the change in demand by the change in the foreign currency. So, this is -2. So we see that the numerator is increasing more than proportionately than the demand denominator. So we see that increase in the change in the demand divided by the change in the foreign exchange, the price of the foreign exchange, so the change in the price. When we see that it is -2, there is a negative impact, yes. Okay, then that is on the lower side, -2. How do we define this one? So whatever is the change in the price, more than that is the change in the demand. That is elasticity of demand for British exports. So how do we explain that? These numerical questions. We'll do these two numerical questions tomorrow. At the end of the day, we cannot spend so much such concentration. Also, general ones we will just look into that. 104 numerical questions. I'll make you do. Which one of the following will appear in the financial account of the balance of payments for Japan? Financial account of the balance of payment. The export of whiskey, the purchase of euros to go on a European holiday, interest received on the Union State government bond, inflow of investment by a high-tech multinational into Japan. financial account, what will appear? The balance of payment has two different accounts. There's one current account and there's one capital and financial account. So capital and financial account talks about all transactions in external assets and liabilities such as capital inflows and outflows. So inflows of investment by a high-tech multinational into Japan. So this will appear in the financial statement, not about export of whiskey or purchase of euros or interest received on United States government bonds, etc. So this any inflow outflow on investment will appear in the capital and financial accounts as part of balance of payment. A balance of payments deficit is least likely to be corrected by which of the following actions? Imposing tariffs on imports, increasing the value of sterling, reducing the level of aggregate demand, discouraging imports. Sterling is the currency of which country? Sterling is the currency of which country?
Sterling,
Which country?
uh,
I didn't hear.
yeah, ma'am, I'm just thinking.
I don't know.
Sorry.
Search and see.
Sterling, does it come to Britain? Like, yeah,
No, no, no.
pound sterling,
Let's see in the
it's not Britain, but UK. Shall I check in Google, ma'am?
I didn't get you.
Should I
Currency
check?
of Great Britain and the United Kingdom. Sterling is the official currency of the United Kingdom. Jersey, the Isle of something. So
Yeah,
pound sterling. Okay,
basically
fine.
UK.
Okay. Now a balance of payment deficit is least likely. Deficit is likely to be corrected by which of the following actions? Imposing tariff on imports is protectionism, not balance of payment. Increasing the value of sterling, reducing the level of aggregate demand. Level of aggregate demand is about controlling inflation. Discouraging imports again is on protection. Quotas are laid down. Again, protectionism. So the explanation is about increasing the value of sterling. So what happens if the value of sterling increases?
Increasing the value of
See here, one important aspect is which country is not mentioned, no? So because this material is all UK's
Yeah,
material,
it's
so I think on that note they are looking at. So
yeah, it
um, so
will
you,
be increasing
this
the value
material is
of
UK's material. So from them, from their point of view, this would be their local currency. So
yeah,
A is protectionism, reducing the level of aggregate demand is controlling the inflation. Discouraging imports having a quota also is about protectionism. So we are left with increasing the value of sterling. So if the value of sterling
value of
increases,
sterling. Yeah,
um,
be only, ma'am, since local goods will be for more,
it will become
will be more
more
only.
expensive
Yeah, so it will be least likely to be corrected. Yes,
because payment has to be made in sterling and sterling is expensive. So when sterling is expensive, the local goods and service. So who would pay for their goods and services when they export their goods? The foreign customers will have to pay. But now the sterling value, they will have to pay it in sterling. Sterling is already expensive. So when they exchange with the local currency, still we see that the product that is exported by the UK turns out to be quite expensive for foreign players. So the balance of when in that case exports will reduce. When the exports reduce, see, balance of payment is a balance between imports and exports. By increasing the value of sterling, the exports of the economy will have an impact. Exports will reduce because when the goods are exported, they will have to pay at a higher value. Sterling is already increased, higher value. If it is higher, exports reduce. When exports reduce, there will be a mismatch between balance. There will be an imbalance between balance of pay. So we can choose B as the answer. Okay, fine. We'll wind it up here. And then the rest of the questions we'll take it up in tomorrow's class and then continue with the other topic in tomorrow's class. Okay,
yes, ma'am. Yes, ma'am.
good day.
Okay. Thank you, ma'am. Bye.